Hello and welcome. We shall be talking about cryptocurrency trading terms, or the terms used generally in cryptocurrency. We shall be looking into the following terms in order to be familiar with cryptocurrency and how to trade. And the first of it all is blockchain, which also I have explained. Blockchain is a distributed ledger which is secured using what is called cryptography. Its database and transactions are accessible to everyone to see, and that's why it is called decentralized, unlike our regular bank. The data is not stored in a centralized server, but it is shared between thousands of computers across the globe. Computers that we call nodes. Now, what this means is blockchain is open to everyone to see the transaction going in and out of the database. So this is why blockchain is very important and the usefulness of it in our day-to-day transactions. So the next one is cryptocurrency. Now, it is a digital asset used as a medium of exchange in business transactions or used to store values. Cryptocurrency examples are like Bitcoin, Ethereum, Ripple, etc. We have over 3,000 plus cryptocurrencies, right? So, and the numbers grow daily. Then we talk about block. A cryptocurrency block is a package of permanently recorded data on the blockchain network. Each row of transaction in blockchain is represented by a block. So let's see how a block is. So looking at this here, this is, we see last block. Okay, so the block, as you can see, this is a block, and the detail of this particular block. It has a height, the hash, the timestamp, the transaction, and also the size, right? So this is example of a block in blockchain. This is example of a one block. This is another block. This is another block, and like I said, each transaction represents or is being stored as a block. And of course we have Genesis block. So Genesis means beginning. So this is the very first block in any blockchain. It means first transaction when a blockchain is created. So that's the very first block you can talk about in a blockchain. It's called Genesis block. We have altcoins. Any other cryptocurrency coin that is not Bitcoin, which was the first cryptocurrency coin, is referred to as altcoin. And the full meaning of altcoin is alternative coin. That is in full. So the next is address. Now, an address represents a unique wallet ID on the blockchain network. It is like a bank account number. Each address consists of between 26 to 35 characters, and that is what is required to send or receive coins. As you know already that your bank account number cannot be duplicate. It can't be the same with another person. So that's how address is also. Now, therefore, an address being like a bank account number, if you want to receive coins, you will need to give your address to person sending you coins, or if you want to send to someone, you need the person's address. Now, each address represents a type of coin. Example, Bitcoin, Litecoin, and Ethereum. So each blockchain currency has its own address. So you don't send Bitcoin to Ethereum address. You don't send Ethereum coins to Bitcoin address, because if you do, your fund will be lost. Now we have bag holder. So a bag holder is anyone that buys and stores a coin is a bag holder. If you buy a Bitcoin, you are holding some bag of Bitcoin. So in cryptocurrency or in trading, we say bag. You can say, I want to hold a bag of Bitcoin. That means you want to buy some Bitcoin, right? So that's what we call, you can say bag or bag holder. Then we have wallet. A wallet is a digital address used to store coins or tokens. So sometimes people also interchange wallet and address. So we have also what we call a wallet or a software called wallet, or particular software which you can be able to use to store different cryptocurrencies. So in this case, we are going to look at Dog Cash. Example here, we have the Dog Cash. So this is actually my Dog Cash wallet that I use to stake Dog Cash. So this is the example of Dog Cash wallet. As you can see, I'm using it to store my Dog Cash. Then you can say also that I'm holding some bag of Dog Cash here. Alright, so this is the example of what we call bag holder and also what we call wallet. So you can send, you can receive here, and as the case may be. Then we have cold storage. Now cryptocurrency can be stored online or offline. When it is stored away from the web or other storage mechanism to increase security, it is called cold storage. This is different from hot wallet, which is connected to the internet and used for day-to-day transactions. So still on the example of using Dog Cash. So this is the example of a cold wallet. This is actually a wallet as a software. So I installed this on my laptop. It's not actually hosted on the web, but it has a connection to Dog Cash blockchain. I'm using this to store my Dog Cash offline. So this is an example of what? Cold storage. Then we have the hot wallet. A hot wallet is that which is connected to the internet and used for daily transactions. When we start trading, all our actions will be performed on the web. We'll be making use of what? Hot wallet. So we have confirmation. This is the verification of a transaction by the cryptocurrency miners, and transactions are added to the blockchain after confirmation. So we have different confirmations, and whenever a first confirmation is done, it's being registered on the block. We've made mention of what block is. Then we have consensus. Consensus is reached when all the network participants approve the validity of a transaction by ensuring the ledgers are exact copies of one another. This is the final confirmation of a transaction. Whenever a transaction is done, that means that consensus has been reached. Digital assets. If a cryptocurrency digitally stores a value, it is termed digital asset and can be freely exchanged or not. Not all cryptocurrencies are traded as coins or currency. Yeah, this is true. You can't trade all the cryptocurrencies. Like I have already mentioned, we have more than 3,000 cryptocurrencies, but not all can actually be traded. So we have the fiat currency. So whenever you hear fiat, fiat means cash. So fiat is our regular cash, which is issued by the government. Example, we have the dollar, we have the pound, the etc. So we have fork. This is applied to blockchain that splits into two separate chains, mainly to accommodate new governance rules. So we have Bitcoin. We have also Bitcoin Cash. Bitcoin Cash was formed as a result of Bitcoin fork. So whenever a fork occurs, a particular blockchain is made to split. So we have going long or going short. These terms are used in margin trading, which one makes profit when the price either increases or decreases. Now, going long means to buy and going short means to sell. When you long, that is when you buy, you will profit when the price goes up, and when you short, you will profit when the price goes down. So we have mining. Cryptocurrencies are mined and not printed like our traditional currencies. The mining process uses computer hardware to solve complex mathematical problems and decrypt hashes. Each miner receives coins as a reward of mining. So in terms of mining as well, still using Dog Cash as example, these are my rewards, right? I'm mining and also staking this. We have mining rig. Now, mining of cryptocurrencies requires a huge amount of power. A mining rig consists of multiple graphic processors, GPUs connected together to increase mining and processing power. In terms of mining rig, you have the connection of multiple systems. Hash algorithm. This is a set of rules that transforms a large amount of data into a fixed length of hash or string of characters for cryptographic keys. Then we have hash rate. Hash rate is the speed at which a computer hardware can decrypt hashes. it is the basics of cryptocurrency mining. So we have halving. The number of Bitcoin mined decreases to 50% every 4 years. This is a process called halving. Bitcoin has a definite supply which limits the number of coins to 21 million. Then we have what we call node. Now blockchain is decentralized and therefore it is not stored in a central location. Rather, it is distributed and hosted by different number of computers called nodes. Each node participates in verifying the ledger within the blockchain. Then we have moon. Whenever a cryptocurrency coin goes on a market run, making the price to go up, it is called or is known as mooning. So whenever the price of any coin goes up, it's called mooning. Then we have pump and dump. Now pump and dump is used to refer to market manipulation by traders which causes the price of a coin to rise or fall. Now pump is when the price of a coin rises and dump is when the price falls. In spot trading, we buy when the price dumps and sell when the price pumps. So that is normal buying and selling of goods and services. You only buy goods to make gains, right? You buy lower cost and sell higher cost. That's the basics. Okay, so we have smart contract. Now this is a set of encoded rules governing business transactions. It is created using blockchain programming language and stored on the blockchain. Volatility is the movement in the price of cryptocurrency over a period of time. Cryptocurrency market always experience wide swings between high and low prices. So volatility is all about the movement of the price of any cryptocurrency going up and down. So we have some basic acronyms to master as well. We have ATH, and this means all-time high. This is the highest price a cryptocurrency has ever reached. So let's see what all-time high actually is here. So we are using Bitcoin as an example here. Okay, so here we are looking at the Bitcoin chart, and if you see here the all-time high, we are going to look at what the all-time high of Bitcoin here is. So as you can see here is $19,686.42. So that's the all-time high of Bitcoin. Since Bitcoin was created, I know you understand what all-time high is now. So we have dApps, DApps, and that means decentralized applications. Any application that is blockchain based and operates in a decentralized manner is called a dApp. So we have DCA, which means dollar cost averaging, and the DCA is an investment technique which is used to reduce the impact of market volatility by spreading out buys and sells over an expected period of time. So it is used to control the movement of market prices. So we have FOMO, FOMO, fear of missing out. This is commonly experienced in a rising market where new investors experience the fear of missing out on gains to be made. The effect of this demand is to drive the market price higher. The fear of missing out can make a trader to enter into a trade hoping that you don't want to miss out on a particular cryptocurrency that is mooning or pumping. It's very good you control also your fear in terms of trading. We have the food, the fear, uncertainty and doubt. So this is a trading emotion that traders experience in a volatile market. I've explained volatility. Any market that is volatile means that the price goes up and down very quickly, and you can be able to enter in and out of a market. ICO, initial coins offering, and it is used by cryptocurrency startups to raise capital for their ventures. This is like an initial public offering in the equities market. Some crypto startups do sell off their coins in order to raise capital for promotion and for growth, though some ICOs are scams. So in the future, if you want to participate in an ICO, you have to first of all verify that the startup company or the startup crypto company is actually legit. So we have the POW, the POW, which means proof of work, and this is used to validate the creation of cryptocurrency by miners who are required to solve complex calculations. So the proof of work helps the mining rig to determine the particular participation of a miner in the mining process. This difficulty is instituted so as to make it harder for cyber attacks to add invalid blocks to the chain. So we also have the POS, which is proof of stake. So individuals can gain rewards through a proof of stake if they hold more currency in their wallet for a length of time, as I have explained using the dog cash. So we have the ROI, the return on investment, and this is the profit made in an investment or transaction. So if you invest on a cryptocurrency, the profit you get from it is called return on investment. So whenever you hear TA, TA means technical analysis, and it is a type of market analysis used by traders to predict price action. So you predict price action based on previous market price and the volume of that particular currency to know or predict the price in the future. So that's basically what technical analysis is.